Greetings, esteemed listeners, and welcome to this edition of the Appraisal Buzzcast, where the muddled noise of the world is exchanged for clarity, insight, and, dare I say, wisdom. Today, we are privileged to introduce a guest whose mind navigates the labyrinth of economic thought with the precision of a compass in a storm. Mark Calabria, a distinguished economist whose insights have illuminated the corridors of policy and finance alike. As we stand at the dawn of a new administration, the air brims with that peculiar blend of optimism and trepidation. Much like a farmer surveying both clouds and sunshine, what better time, then, to hear from an expert who can separate the wheat of potential growth from the chaff of wishful thinking? Dr. Calabria brings us not just numbers and forecasts, but a reasoned perspective on how policies and possibilities converge. Let's lean into this conversation about the prospects for economic growth, for while the future remains an inscrutable mistress, we may yet prepare ourselves to greet her with sharper minds and steadier hands. Stick around.
Are you ready to take your career in real estate appraisal to the next level? Join the Appraisal Institute, your go-to source for expert insights, industry trends, and the latest updates from the world of valuation. Whether you're an experienced appraiser or just starting out, they bring you industry resources, classes, and all the knowledge you need to stay ahead. Join today and be part of a community that's shaping the future of the appraisal profession. Visit appraisalinstitute.org to learn more and become a member. You're listening to the Appraisal Buzzcast with your host, Hal Humphreys.
Welcome back, everybody, to today's Buzzcast. I'm Jim Morrison. With me, as always, is our host, Hal, who you heard from already. We're really excited to have Mark Calabria joining us today. Mark is the former director of the Federal Housing Finance Agency and also served as the chief economist for the vice president. He's currently a senior advisor at the Cato Institute and the author of Shelter from the Storm, How a COVID Mortgage Meltdown Was Averted. Let's bring him in. Hey, Mark.
Hey, Jim. Hey, Hal. Great to be here.
Good to see you, Mark. Jim, thank you. Mark, thanks so much for taking the time to be with us. It's always a pleasure to have you on the show. Before we dive into what's happening now and what you expect with the new administration, let's give our listeners a real quick refresher. Can you share a bit about your background and the path that led you to your role as the director of FHFA?
Sure. I would say it actually goes all the way back to when I was an undergrad and I was finishing up, and it was I finished undergrad into the savings and loan crisis. I think there were a few appraisal issues at that time as well. A lot of FHFA, all those things that came out of it. And in fact, the reason I decided to go get a PhD was because the job market was so bad at the time. And it really, was a broader point of things going on in the real estate market and the broader economy, do frame up the choices you have in your life and the career path. And that decision to get a PhD in economics and later work in the industry. First job out of grad school was National Association of Home Builders. I worked at National Association of Realtors, Harvard Joint Center for Housing Studies. So really began my career really looking at the real estate market from a policy analysis view. And then, of course, have had the privilege of several rounds of public service, first on Capitol Hill, the Senate Banking Committee, and then later, obviously, at the White House and at the FHFA.
Mark, you've tackled some fairly substantial crises during your career. When you're working on solutions to address economic challenges, what are some of the biggest factors you take into account?
Great question. So, probably the biggest crisis I dealt with in some sense, other than the 2008, was I was our lead staffer on the Senate Banking Committee for Katrina. Immediately went to the Gulf, started in Alabama. I was working for Senator Shelby, of course, at the time. So it wasn't just a New Orleans focus. It was Louisiana, Mississippi. And I remember not 20 minutes after landfall, kind of coming up with my own estimates on what was the size of the New Orleans housing stock, what were likely damage estimates. And so I always start things, whether it was the pandemic or whether it was 2008, or whether it was Katrina, trying to get a handle on the scope of the problem. How many housing units are we speaking? What's the value? What's the likely number of homes impacted? So to me, and again, I also remember as the pandemic was unwinding, sitting around with my senior team and asking ourselves, well, what do we think servicing problems are going to be? How many homeowners do we think are going to be in forbearance, Fannie and Freddie? So I always try to first approach this from a very numerical standpoint, so I can scope the problem, if you will, and have an understanding. And then second, and I think this is just as critical, stopping and asking yourself, what is the actual problem you're trying to solve? And I think part of the problem in Washington is, everything is filtered through interest groups. And sometimes what the lobbyists tell you their problem is not necessarily your problem or the public's problem. And so I think it's really important to scope out what's the issue. And I think the best example of this, that we see nowadays is with housing affordability challenges. You may remember that when Vice President Harris was running, she talked about building a very large down payment assistance program. Now, the tension with this, and again, this is a very common reaction, and I've seen a number of surveys of the public, and if you ask the public, is housing unaffordable? Obviously, most of the public says, yes, it's unaffordable. If you ask them, will building more housing make it more affordable? You get a lot of people who say no, which is kind of puzzling. And if you ask and you poll people on various solutions, people really love down payment assistance, even though obviously giving people more money to buy when the market is supply constrained simply runs up prices. But it's a very popular solution, even if it's a solution that makes the problem worse. So for me, my always starting point is, what is the actual economic, social problem we're trying to fix? And of course, later you have to ask yourself, are the fixes you're coming up with politically sellable? Is it feasible? Can you actually do what you want? But to me, one of my knocks on Washington is the process often starts out with thinking what's politically feasible first, rather than thinking about what's the actual solution to the problem you're trying to solve.
In listening to your answer, being a real estate appraiser, I'm hearing certain things like defining the problem, developing a scope of work, analyzing the highest and best use. I mean, these are all things that we as appraisers are very familiar with. Is the place you start is you define the problem, and then you work from there.
And I think that's really one of the kind of fundamental tensions around the policy debate among appraisals. So my view, of course, is you want a number that best reflects what the market value is likely to be, understanding that there's some wiggle room. And at the end of the day, there's nothing like a sale comparable that determines that value. So, for instance, one of the things that really struck me during Katrina was that the vast majority of properties in New Orleans, even pre-Katrina, were worth less than the replacement value. And so you can't look at this and say, well, this is what it costs to build this property, therefore that property must be that value. Nope, that doesn't mean someone's willing to pay that for it. And part of the problem is you've gotten this dialogue over the last couple of years where people want to believe that whatever the appraised number is suddenly going to create wealth. Like if I tell you that even though your house is only worth $200,000, if I come in and tell you that it's worth $400,000, I have suddenly magically created $200,000 worth of wealth for you. I have not. It doesn't work that way. But, again, there really is this tension where people want the appraisal to be something other than an accurate reflection of value. And I think that's really where the political debate and the tension today is.
Fair enough. I like that. That's a really good analysis. All right, let's do this. Let's shift gears. We've got a new administration in place. They've rolled out some big plans. There's been a lot of discussion about cutting government spending. Do you think those spending cuts are feasible? And if they are, how do you see that impacting the real estate market?
So let's divide feasibility into two buckets. First of all, are they mechanically feasible in a way that aren't going to, sink our economy and then sustainable? Absolutely. People kind of give the Doge and Vivek and a hard time for saying 2 trillion. If we simply went back to 2019 spending levels, you would cut the government by more than 2 trillion. And I don't remember the federal government in 2019 being necessarily too small, in my view. So we forget that there was just a huge ratcheting up of the size of government. Obviously, some of that was pandemic related, but a lot of it is permanent if we don't roll it back. So as an economist, yes, I believe we can get back to more sustainable spending levels. I think the difficulty, of course, is the politics, because you do get this resetting, of people's expectations. And once you've spent a lot more money, you create interest groups and constituencies around that money. So, it becomes much more difficult to roll that back. But that said, if we don't roll it back, I think we're ultimately going to see considerable upward pressure on mortgage rates, from the treasury market staying very high. We have been able to fund our treasury market because the Federal Reserve buys a lot of those treasuries. Financial institutions like banks and insurance companies buy a lot of those treasuries. So you kind of have a captive market. Much of the rest of the world, China, Japan, buy a lot of those treasuries. But there is a limit. It's one of these things that you're eventually going to hit the wall. And when you do hit the wall, you could see quite dramatic and short and even really quickly large increases in interest rates, which will have a very dramatic effect on the housing market. So to me, it's an inevitability if we don't change our fiscal path that we will see interest rate increases either from monetarizing the debt and therefore inflation, or via concerns about default and essentially eroding away the real value of the debt. And again, as long as the rest of the world believes that treasuries are the equivalent of cash, then we have a pretty long runway. So I don't want to sound like, no, next year we're not, we're not experiencing hyperinflation and default. That's not what we're looking at. But we are looking at over a 25 to 35 year process going the way of Greece. So this isn't, we don't have forever, but we do have a long runway. And of course, my view is, since you've got a long runway and the sooner you start, the less pain there is, that we should really immediately start getting our fiscal house in order rather than put it off for the last minute.
Okay. All right. I want to just kind of noodle around another topic here.
Sure.
Nashville has seen home prices increase recently, actually for the past several years. But DC specifically, there's a little of a boom going on in DC right now, partly due to government employees being called back into the office. How does this factor into the overall market?
I mean, this is very DC specific in that while a lot of industries still have a considerable amount of remote work, many have started to come back over time. And as you start to see softness in some parts of the job market, you as a potential employee today probably have less leverage via your boss than you did 2 years ago. And so to be able to compete 2 years ago, many employers are very willing to be flexible because they needed talent. And that has shifted a little bit. So, I think the expectation that you can get the job of your dreams and work from anywhere you want is becoming less of a reality than it was 2 years ago. Now, the federal government has still been the case where you go down to, HUD on any given one day of the week, and you're lucky if 5-6% of the building is there. So the federal government has really, partly because it's heavily unionized, partly because it's political. I mean, the Biden White House made a couple of attempts to try to get people to come back, and there was just so much blowback from the employees. Now, as you know, President Trump has announced that federal employees will be returning to the office. So you're going to see this big push in Washington, bring people back into the office. That's certainly going to provide some support to the DC and Virginia, Maryland suburbs of DC real estate market. Of course, a lot of people are going to have to make choices. You had a lot of people who moved outside of DC. In some of the markets, I mean, there have been select markets. You think places like Myrtle Beach, Hilton Head, where, if you're living in DC and you're thinking about, okay, I'm going to make, last couple of years, I'm going to stay being a federal employee, but I'd like to live in a slightly nicer environment, but I'd like to be, a drive, a reasonable drive to the office. So I have to go there for an emergency, which, is 5 or 6 hour kind of circle. So places like the shores of North Carolina, South Carolina have really seen an influx of federal employees, for instance. In
Okay.
those markets, I think we'll see a lot of softness. And again, a lot of people will choose to retire. Some people will choose to sell their house. And you've also seen this, West Virginia, kind of, parts of Pennsylvania have benefited. But you're going to start to see those markets soften as the inner ring DC comes back a little bit. And I certainly don't want to exaggerate a little bit. And it also is reinforcing. So, at the Cato Institute where I work, maybe people are in 2 days a week. And partly because, the Cato Institute does events, but if there's nobody in DC to come to our events, then we switch them to virtual. And so there are a lot of things in DC where less people come back if the federal employees aren't there, but when the federal employees come back, then the lobbyists and the think tankers and everybody else start to come back in a bigger way too. So I do think the course of 2025 is going to see a lot of people returning to the DC real estate market in a big way. Now, I think other markets, you were going to continue to see softening in the Southeast. Other markets are going to continue to see some supply constraints. But, as our realtor friends always say, location, location, location.
No doubt. So shifting gears once again, you spent a bit of time at FHFA as the regulator controlling the GSEs. I'm thinking specifically Fannie Mae, Freddie Mac. This is an issue that's critical to the future of the housing finance system. Let's start with your overall stance. What's your take on conservatorship?
So, and I'll also add, I worked on Capitol Hill and helped write the statute that created FHFA. So, I have the experience of not having just run the agency, but also had the experience of creating the agency and being involved in the congressional debates over what was the objective of this agency. So let me say, when we were writing the statute, if you had told us that a conservatorship would have gone more than 6 months, we would have been shocked. So, nobody thought 16, 17 years. Nobody envisioned this kind of length to a conservatorship. I believe the longest a bank conservatorship was 18 months. So it really has been unprecedented. In fairness, I believe there are some railroad receiverships that have gone on for 30, 40 years. But, by and large, these things get resolved in relatively quick manner. This is not, in my opinion, played out the way Congress intended. And so I think it's incumbent upon FHFA to resolve the conservatorships. And I think you'll see a switch back from this administration because there is a basic philosophical difference. I mean, the Trump administration, regardless of agency, whether it's DOJ, Interior, FHFA, HUD, does take the view that agencies should follow the law and not try to be really creative. And I think that what you saw in both the Obama and Biden years at FHFA was a view of, well, can we get away with this or not? Not a view of what does the law say, but rather a view of what are our policy preferences and objectives, and can we come up with some thin legal justification to get away with them? That's not necessarily going to be the approach of the new administration. And you've already seen this. I mean, we just had a Treasury Secretary confirmed, he said in his questions to the record that he believes the conservatorship should end. And again, that is the law. So that said, there are a lot of bumps along the road. And if I had to, handicap it, I would say there's about a 65% chance that conservatorships will end by the end of 27.
Okay.
No chance they'll end in 2025. There's really just too many process things that need to be done. But I give it about a 65% chance because there are things that can go sideways. We could have a major downturn in the housing market. I hope not. But if you did, that's going to delay an exit. You're going to burn through. So, for instance, I don't think people are truly appreciative of how close Fannie and Freddie came to failing during COVID. They suffered about $7 billion in losses from COVID, and they went into COVID with just around $6-7 billion in capital. So we were able to keep building capital, but the losses almost wiped them out. And so while I do not believe there's a significant chance of a major housing downturn, we are seeing a number of markets soften.
Yeah.
And, we're probably in the fifth inning of a correction in the multifamily market. A lot of stress coming in multifamily in certain markets. At this point, I'm not convinced it's enough to sink the GSEs, but I'm also not convinced that it's not. So it is something you need to keep an eye on. I am hopeful that given the cash flow position they're in today, that they can avoid failing again. But if they do fail again and become insolvent, that's gonna, that's gonna take exit off the table.
So what I'm hearing you say is, and this is a phrase that my dad used to say, there's many a slip betwixt a cup and a lip.
Absolutely. So again, you have to kind of keep in mind, just like, my expectation was we were going to get them out in 2020, but like a lot of other people, I didn't foresee a pandemic.
Yeah, and these are things, the unknown unknowns.
Exactly.
Yeah. All right. So if the conservatorship comes to an end, what are some of the key factors policymakers are going to need to address before making that move? Before, if they want to say, all right, we're going to end the conservatorship, what are some of the key factors the policymakers are going to need to address before they actually start that process?
So let's start with, you need to continue building capital. And of course, between the two companies, they're probably accumulated about 25 billion a year now. So one reason why I think 27, 28 is more likely is because you'll have another 75 to 100 billion built in capital, which is a significant chunk of capital to get them out. You also have a number of things that have been done under the conservatorship that would go away and that you need to do via regulation. Now, the best example of this during my time was when I became director, new products were approved or disapproved by the conservator. And of course, that's supposed to be done by regulation. We did a rulemaking, we did a regulation, and it takes you really a year to do a rulemaking and a regulation. So there'll be a host of things where these things move from conservatorship commands, if you will, to regulations. Now, the plus is that when I was there, I asked the legal staff, write me a list of all the things we've done as conservator and give me the legal justification. Tell me what we need to issue by regulation so this stays. And of course, let me know what just goes away. So there is a list. It's on a shelf. You're not starting from ground zero. But to do all this rulemaking is going to take you 12 to 18 months. And that needs to be finished pre-exit. Perhaps one of the bigger, harder ones to figure out is, what do you do with the uniform mortgage-backed security? It needs to be fixed because, quite frankly, it's not legal under our antitrust laws. You have a huge joint venture between two duopolists. Your options are to hope Congress comes in and gives you an antitrust exemption, or you open it up to competition, which is what we were doing. We were looking at having Ginnie Mae shift some of its operations to the UMBS platform. Or quite frankly, perhaps the cleanest option is you just roll it into Fannie, because Freddie has the capacity to leave the single security platform today. But you need to do something to fix it because, again, it's not legal, and you need to make it legal pre-exit. Now, there are a number of things that, every every multi-trillion-dollar financial institution has problems, whether you're Citibank or Chase or Fannie. And so a number of those, just day-to-day, internal controls, IT, security that need to be addressed. And it's also important to keep in mind, Fannie and Freddie were not regular Securities Act filers until 2008. They weren't under Sarbanes-Oxley until 2008. So I would say you need to, hire a lot more accountants. You need to deal with internal controls, and you need to deal with many of the procedures that would put in place for these companies to be traded on a stock exchange again and to be public companies again in the same way. So plus is that almost all of this has been mapped out. It's all on a shelf. You don't need to reinvent the wheel. Almost every conceivable question you could think of, we scoped out. Didn't always necessarily decide on an answer, but we had a range of answers. And all that is on a shelf where whoever comes in, whether it's Bill Pulte or somebody else, or whether Treasury's involvement, White House involvement, we spent a lot of time, hired Houlihan Lokey, which is probably one of the most prominent expert reorganization turnaround firms in America. These guys, this is what they do, reorganizations. And so really we scoped out a lot of options. And so I would simply say it's not conceptually difficult. It is time intensive and resource intensive, but it's completely doable in a 2-year time frame, in my view.
Playbook's there, not going to happen overnight.
Exactly. And you got to get the players on the field.
Yeah. Yeah. Okay. Let me do this. I want to take a real quick break and hear from one of our sponsors, and we'll be back.
LIA Administrators and Insurance Services, serving valuation professionals since 1978. We provide E&O insurance with a commitment to superior customer service, outstanding liability education, and unmatched claim defense. Explore our exclusive appraiser liability education by Peter Christensen and cost-effective seminars designed to foster your growth. Our underwriters, with an average of 26 years of experience each, are dedicated to supporting appraisers. Visit liability.com to discover how LIA can safeguard your business.
Welcome back, everybody. You're listening to the Appraisal Buzzcast. I'm Hal Humphreys, your host. I'm joined today by Mark Calabria. Mark, thank you again for taking the time to be here today. I always enjoy your insights. I've said this before. I could sit and talk to you for hours on end and never get bored. So thank you for sharing your insights. It's going to be an interesting time in the next few years to see what happens. And for our appraisers out there, we're talking about Fannie Mae, Freddie Mac, FHFA, the housing market, the mortgage market, the whole thing. There's a lot to consider. And I think, Mark, if I could just sum it up again, the playbook is there to make some changes, but it's not going to happen overnight.
Yeah, it's going to be a process. Now, if we want to talk about maybe some of the more specific appraisal related issues, I think we can put those in a couple of buckets. First of all, while obviously our fair lending laws stay in place, PAVE has got to be put on ice. This pressure from HUD, FHFA to essentially push up appraised values, I think that's going to greatly decline. There's a lot of skepticism from the incoming administration about some of the elements of PAVE. Now, there's obviously always going to be a reconsideration of value process. How that may change and get tweaked, I think, is still yet to be seen. But this kind of pressure on appraisers to hit a certain number and to me, take race into account. There also was, considerable amount of pressure. To me, a very misguided attempt by the last administration to make lenders responsible for the appraisal, and in my opinion, to ultimately undermine appraisal independence. So I think you're going to see a return toward appreciation of the importance of appraisal independence that I think was lost in the Biden administration. Now, let's kind of think about maybe some, risks, if you will, especially from exit. As you and I have talked about before, Fannie and Freddie sometimes look at the appraisal process as what they would call a friction.
Mm-hmm.
And, I don't think there's really a true appreciation in Washington that the appraisal process protects not just the lender and investor, but also the consumer.
Yeah.
And so you will see a little bit of pullback where the pressure and perspective in the Biden administration was so much on access. We must get people into loans, and let's, get rid of any safeguards that we think are too onerous. And of course, appraisal fell on that list. You're going to see a little bit of change away from that. You're not going to see an abandonment toward access. Obviously, housing affordability was one of the things that I think drove the election. So certainly the Trump administration is not going to abandon the conversation about access, but I think it's going to be a little more nuanced, and I think it's going to be a little more balanced. And I think it's going to be a recognition that the appraisal is an important safeguard in the process, not a friction and obstacle to be thrown aside. That said, if we do see an exit at some point, so I say the current environment is, depending on the politics of who happens to be running FHFA, depends on whether appraisals are good or bad. And that's unfortunate. That should not, this should not be a political football. Part of my worry, and I think you need to put this into place, and it's something the industry needs to make sure that the administration hears, is outside of conservatorship, Fannie and Freddie are going to be much more commercially oriented. Now, I think that's largely a good thing for them to think like businesses again, but it will mean that they double down on kind of having a market share perspective. And one of their ways, in their view, to gain market share, again, is to iron out frictions, including appraisals. So it's so important that before they exit conservatorship, that the FHFA, as a safety and soundness regulator, puts procedures in place that to make sure that collateral evaluations are done in a smart way that protects safety and soundness. So one message that I would send to the industry, you have about a year and a half, maybe two, to make sure that FHFA, as a safety and soundness regulator, has hardwired protections for and independence for collateral evaluation in the process. Start immediately. Go.
I like it. I like it. Don't sit around and wait for things to change. Be proactive. Get out there and make the voice heard for the appraiser part of the equation. And Mark, you and I have talked about the notion of the appraisal. It is part of a process about analyzing risk. You've got a credit risk analysis and you've got a collateral risk analysis. I think there will always be a place for appraisers in the collateral risk analysis. I do think that if the GSEs come out of conservatorship, we're going to see them pushing for less emphasis on the appraisal part, and more emphasis on automated valuation models, acceptance, value acceptance, and waivers and stuff like that. But I do think there will always be a place for appraisers in the market, because at the end of the day, we have to know what the asset is worth in case everything else goes out the window.
I would very much agree. I think the question is, does that role get narrowed? Does that role lose some independence? And so I think that role is going to continue, and it's funny because, it seemed like just yesterday that Zillow almost blew themselves up thinking that they could determine values better than the market. But people have forgotten that. That's ancient history at this point. And some of this stuff does go in cycles. And so, we went through a period where many people in Washington, and I should say, I have a PhD in economics. I've run hedonic regressions. I know what goes into an AVM conceptually. And I think they're important quality control checks. At the end of the day, there is a knowledge of the marketplace, and there is, as you would say, is a statistician say unobserved variables that the statistician doesn't get, that the appraisal does get. And again, Zillow found this out the hard way. I worry that some of the enthusiasm at Fannie and Freddie for AVMs might mean that they might find it out the hard way, and might mean the taxpayer finds it out the hard way. With that said, it's always going to be a role there. It's just a question of, how much influence does that role have? How much responsibilities does that role have? So I think it's important to keep in mind, and I said, I worked earlier in my career at NAR, I appreciate realtors, and I recognize that the appraisal industry often has a role in relationship with NAR. But, NAR has a whole lot of, especially nowadays, a whole lot of public policy issues on their plate.
Yeah.
And the point I would say, there's a quip in Washington that if you're not at the table, you're on the menu. And it's really just important that I think the appraisal industry makes its voice heard in Washington. And you can't assume that other people are going to be there advocating on your behalf.
Absolutely. Mark, thank you again for taking the time to be here. Jim Morrison, is there anything else we need to cover today?
No, Mark, that was such a great conversation. We're going to include a link for Mark's book if anyone wants to hear more from Mark. Mark, you always do a great job. Thanks so much.
Thank you, Jim. Thank you, Hal. So great to see you.
Thank you. And if we have nothing else, for Jim Morrison and Mark Calabria, I'm Hal Humphreys, and that is your Appraisal Buzzcast for this week.